Today we're talking cash flow analysis in our new format on another episode of Ask Prof. Joey C. Comps, aka comparable properties. This valuation approach does not always make sense when buying an income property. There are some neighborhoods that make sense to flip a property, but you can't make real cash flow from if you're trying to rent the property. So a great way to find your actual value of your property is to back into it by doing a cash flow analysis and then find out the number that you can purchase and construct the property for. So for our subject property that we're going to use in this cash flow analysis, we purchased the building for $50,000. And we are anticipating in putting $50,000 of construction cost into the building. We need to see if this makes sense by backing into the numbers. So the best way to do this is simple math. Once again, keeping it simple. So we start off with the income. Our rent for the subject property is $1,200. Our expenses include our utilities, which include water, gas, electric, and trash, all of which are zero. Why? Because this is a single family house where the tenant is paying the utilities. We have our insurance payment, which is $50 a month, which is average for a single family home in our area. We include a management fee, which is 5% of the gross income of the property, which equals $60 per month. Then there are the taxes, which is 26 mills.
Joe, what is a mill? What does mill mean?
Jargon. Good catch, Benjamin. A mill is the millage rate. In our city of Pittsburgh, that's how they calculate the taxes. So, for instance, if our millage rate is 26 mills, that is 0.026 times the assessed value of the property. That's how you get your annual taxes.
And where does the assessed value come from?
Benjamin, spot on. The assessed value is a value the county places on the property. That's usually derived from comparable properties in the area, and most importantly, what the property last sold for. Now, you're purchasing this property, so it could be assessed at the value the last person bought it for, a value that the county says it's worth, or it could get reassessed to the value that you purchased it for, and possibly assessed above the value of what you bought it for if the area is appreciating. With our subject property that we bought for $50,000, the actual assessment of the property by the county was for $60,000. So that is the value that we use to derive our tax number. Now, caution, there's a variable. It could go up or down based on what the county decides to do. The good thing for you as an investor are counties and municipalities, the government moves slowly. So you should have a year or two before you get reassessed. But you have to be aware your assessment could go up. The next line item are allowances. I like to leave a vacancy rate and a capital reserve allowance in my property. The vacancy rate, I use 7%. This is a historical vacancy rate that I take from Pittsburgh statistics. Use your area statistics to find your vacancy rate so you can allow for the what ifs. If a tenant leaves in the middle of the night and doesn't pay you, or if you just need a month to get the place leased to the best possible tenant. We also allow a capital reserve or capital expenditure reserve, sometimes called CapEx. This is money we set aside each and every month for even more what ifs. For instance, what about if the roof goes or a window leaks or you have to make a major repair to a water tank or a furnace? That's our CapEx reserve, and we're allotting $50 per month for this particular property. The next line is our net operating income. That is our income minus our expenses and then minus our allowances. The NOI, as it's called in the biz, is a very important number when you're trying to derive value in your real estate. This is going to be the number you use when you're using a cap rate to derive the value.
What is a cap rate?
Benjamin, coming in the game for the third time. The cap rate is a way to derive your value using your net operating income. So you're telling how much the property is worth if you didn't use any bank leverage. So if you were keeping score according to cap rate and you took your NOI and you took the value of this property, remember $50,000 to purchase and $50,000 to repair this property, that would make this property a 10 cap. If you need more information on cap rates, go to investopedia.com and look it up. It's a big time word that you have to know to be a big time investor.
To calculate your cap rate, take your monthly NOI and multiply it by 12. Then take your annual NOI and divide it by your total investment. This will give you a small decimal number, which needs to be converted into a percentage. For this example, that's an NOI of $826 times 12, which equals $9,912. Then we'll divide that by our total investment of $100,000, which gives us 0.09912. This equals 9.912%, or approximately 10%. That makes this investment a 10 cap.
The next line item on our cash flow analysis is our mortgage. Our mortgage in this case is $528.
Our mortgage is calculated by taking our 80% LTV loan to value, which is $80,000 from the bank, with a 5% APR, which is our interest rate, over 20-year amortization. If you need help calculating your mortgage payment, visit www.amortization-calc.com.
Well, after we subtract our mortgage payment from our net operating income, our cash flow per month is $298.
So to recap, our overall investment is $100,000. Our rental income is $1,200 per month, and our expenses and allowances total $374. This gives us our net operating income, or NOI, of $826. Then we have our mortgage payment of $528. When you total all that together, it gives us a cash flow of $298.
So if your loan from the bank was $80,000, that means you had $20,000 of your cash tied up into this deal. So if you take your $298 per month times 12, giving you your actual annual cash flow after your debt payment, that would mean you're getting an approximately 18% cash on cash return on your $20,000 of the cash you invested out of your pocket. So now that you have the numbers, you know what cap rate you're working with. You know your cash on cash return on your cash flow. Now it's your job to determine, do these numbers make sense for you to invest in this property? An 18% return is a phenomenal return. That's going to be over double what Wall Street is going to give any investor investing in the risky stock market. A 10 cap property is also a very solid cap rate in comparison with a commercial grade asset. For instance, a Starbucks might trade at a 4 to 5 cap rate, meaning it would yield a 4 to 5% return on that investment. In your investment, you're going to be yielding a 10% unlevered return. So the numbers work, at least in our book, on this investment. But it's also important to step away from the numbers. Does $298 a month make a difference in your life? You might say, well, not really. Well, does that make a difference in your life if you did 10 properties or 20 properties or 100 properties? That's the way real estate investing works. You got to determine if the amount of work that you have to put into this investment makes sense for that $298 per month. Now, there's other benefits to real estate investing, like the tax benefits, the long-term appreciation of a property that now you own. There's also the principal pay down that you're going to be paying down every single month on the mortgage. So there's other ways that you're going to be making money on this investment. So keep it simple, jot the numbers down, and see if the investment makes sense for you, and start building that portfolio using these tips and tricks on cash flow analysis. Remember, if you like this, Please subscribe on Facebook, on YouTube, and follow us and comment and like on everything we do. We love your feedback and it keeps us motivated to give you more and more content to help you in your real estate investment career.